So, do you ever have a bias, but then you struggle with how to enter the marketplace? Well, in this video, I'm going to be breaking down all the best entry models anyone can use starting today. Now, this video will be focused specifically on the lower time frame entry. So, if you're someone who's already struggling with bias and you want a better understanding of how to determine market direction, make sure to check other videos on my channel, which I have in the link in the description below. As well as make sure to join my public Telegram, where I have over 33,000 people, where I post daily and weekly analysis, as well as showcase concepts I talk about here on this channel, but in real live market conditions. And don't worry about it, this is 100% free. Check the link in the description below. Now, let's get into the video and let's talk about the keynotes that we need in order to talk about entries. Now, what I'm about to show you in this video are entry patterns. And I just want to clarify, entry patterns are just that. They are only patterns. Now, the key is to couple the entry patterns that we see in this video with our higher time frame narrative, as well as including time elements. This is where you'll see me usually talk about context and variables, and you need to utilize these lower time frame entries within the proper context. Now, the best entry patterns will form under the following conditions. So I'm going to go ahead and actually give you guys the exact variables and context I need in order to determine lower time frame entries within a higher time frame narrative. Number one, we need to see a run on stops. This is very important for me. Run on stops, we need to see liquidity taken out. Number two, time window. There has to be some sort of time component to it because volatility is high during specific times of the day. Number three, it's in line with a daily profile. Number four, it occurs at a key level. So typically when we have all four of these in play with our lower time frame entry and then within the higher time frame context, this now makes things a lot more powerful because now we have additional confluence. And now the patterns aren't just that, they're patterns with context and narrative. Now, if you have a weekly profile, this is also a plus. I have a separate video talking about daily profiles, and weekly profiles are coming up, so make sure to subscribe to the channel for all videos in regards to the marketplace. Now let's get into it. What are the bearish confirmations? What are the bullish confirmations that I use in order to determine a lower time frame entry? Now, there are 6 that I'm going to talk about that I personally use on a day-to-day basis that has made me multiple 6 figures in payouts. Now, I'm going to talk about the last one because this is by far my favorite one, and I'm going to keep this towards the end of the video and I'm going to reveal exactly what it is. But in the meantime, let's talk about the other bearish confirmations, and we're going to reverse this for the bullish side. Number one is OTE. Typically, the market has an impulse push lower, and then we just have a retracement above the 50%. So if you draw a fib from swing high down to swing low, we're going to see a retracement back into the 50%, the 61.8%, etc. And don't worry about it, guys. I'm going to show an example of every single one of these later in the video. Next, we have what is known as CISD, which is change in states of delivery. This just pretty much means that the market has a impulse push up, and then we have an aggressive impulse push lower, which creates the order block. This is change in state of the delivery, change in state of price. Typically, there doesn't have to be some sort of market structure break for this, and sometimes we just have the order block formation. Next, we have is inversion. I really like this one. We have a bullish fair value gap. The market, again, maybe runs some stops at a key level during a specific time window with variables, and then we end up inverting that. So the market breaks back below that bullish fair value gap, we retest it on the opposing side, and then we look for the market to trade lower. The fourth one is the breaker / unicorn setup. This is honestly a lot of people's a really good go-to within the SMC community, where you have the breaker point coupled with a fair value gap. That's what kind of calls it a unicorn, where you have the market make a push up, we clear some sort of liquidity, then we have a breakdown below, we have a market structure shift. Typically, there's going to be some sort of fair value gap or imbalance. Then the market comes back into that area, and then we look for the market to trade lower. Now, the fifth example is the balanced price range. This one is kind of similar to the inversion, but typically you'll have a bearish fair value gap. The market inverts it within a bullish fair value gap as well. This overlap in fair value gap is what we call balanced price range. Very similar concept with the inversion, but the only additional requirement there must be a bullish fair value gap in this example that overlaps with the bearish one. And then for the last one, I'm going to go ahead and talk about it. So make sure to stay to the end of this video because this is, again, one of my favorite ones I've used to make multiple 6 figures in payouts. Now, inversely, we have the same thing for bullish confirmation, so I just want to include this as well. By the way, guys, make sure to join the Telegram below. I will start posting these PDF and resources inside the Telegram, so join that Telegram. Link in the description below. It's 100% free, and you'll be able to get this PDF as well. But again, for the bullish side, it's all inverse, so I'm not going to go over it in depth, but it's the exact same thing, just the inverse scenarios. So, balance price range. Let's go ahead and we're going to start talking about each individual ones as well as providing examples with every single confirmation entry. Now, balance price range, as we talked about, you typically will see a bearish fair value gap, then the market inverts that bearish fair value gap with a bullish one. Then we'll typically look to enter the market when it comes back into the bullish fair value gap, but having this price signature just adds an element of confluence to this. Inversely, if we have a bullish fair value gap, the market may come into a higher time frame level, we may be clearing liquidity, and then we finally invert that bullish fair value gap. The market will create a bearish one on this leg here, and then again we look for that retracement back into this level for a continued move down. Now this is one of my favorite ones as well. Honestly, to be fair, I feel like if you nail the higher time frame narrative, the point is to use any of these setups to get into the marketplace. Now, here is a perfect illustration of it from both sides on the bullish side. So notice how we have this bearish fair value gap. The market takes out this prior candle's low. Let's just assume there's a higher time frame key level. Then the market has an impulse push up in here where we create a bullish fair value gap. And this is essentially where we're going to try to look for any potential entries on a retest because this fair value gap overlaps this bearish one. Now the market does come back in here, tests it right to the low, and then we see the market push higher, making new highs, tacking on all the liquidity that's resting to the left hand side. Now again, let's look at a bearish example. The market has a swift push up. Notice how we clear all these highs. Again, let's assume there's a higher time frame key level. Notice how the market breaks down below. We inverse this bullish fair value gap, and then the market breaks down below. Now notice how in this example we have a bearish fair value gap that's present, and then we look for the market to trade back up into there until we have the move lower, which then we start to clear out liquidity, we start to clear out lows. This is a very simple entry technique. Now again, some people could argue that this and inversion are pretty much the same. The thing is with the inversion, sometimes with the inversion, there isn't a bullish fair value gap like in this example, and there isn't a bearish one here. But then sometimes people will just take, like if the market, let's say on this next candle runs up, test that bearish, the inverted fair value gap, they could just typically take an entry. Again, we'll talk about that when we get into that example. Now, CISD, change in the state of delivery. Let's just assume that the market pushes up into a key higher time frame level during a specific time window. Now the market has an impulse push lower, and now any up close candle before the move lower, this becomes our change in state of price because now the market has potentially shifted bearish. Same in this example, the market has potentially shifted bullish after creating this last series of down close candles before the push up. Now, in this example, we do not need a market structure shift. If we have proper context, sometimes people will look for that retest and then look for the move lower, assuming that this high is going to be staying intact and assuming this low in a bullish example will stay intact. Now let's go ahead, let's look at an example of this. Notice how the market in this example, we have the low to high, and then the market has a break back below. Look at the series of up close candles down into the high, breaks down below. That's where I have this range set in. This is change in state of price. Now the next candle, the market opens up, tests that level. This is where we can put our entry. This is where we can put our stop loss above the high, and then we look for the move lower. This can be on any time frame. This could be on a daily time frame, or if you're using a lower time frame entry, this could be on a 1 hour, 4 hour, it depends. Now again, the key, remember, every single variable, clearing liquidity inside of a time window at a key level. You don't even need daily or weekly profiles, that adds to it. But again, if you have those 3 elements, you have a high probability scenario if you have a good higher time frame context. Inversely, look how we have these last series of down close candles. The market has a push up, the market retests, and then we make new highs. Again, change in state of price. It's essentially just the order block formation, but it has a nice little name to it and that people have coined it. So again, I wanted to include it in this example. Now let's go into like one of the most favorite ones, the breaker and the unicorn model. This is a very simple one where the market has a swing high, swing low. The market makes then a new high, essentially taking out liquidity. And then we have a break below a prior swing low, below the prior swing low, essentially a market structure shift. And then we have a fair value gap element to it. So now the breaker, I want people to understand what the breaker range is. It's essentially from this swing high to that swing low. This is like a deviation. This is the manipulation move. So this is going to be our breaker point. Typically, we have a fair value gap on the impulse that broke structure. That is going to be an extra confluence. We typically look for that retracement point to sell short and then look to target some sort of downside objective. Inversely, the same thing here. We have a swing low, then we have a swing high, and then the market makes a new low followed by a higher high. Now this again is going to be our breaker range as well, and we're typically going to look for some sort of fair value gap on the leg that broke structure to the upside. When we have this combination in here, we can look for the entry, and I'll show you guys how to place your stop loss in the next slide as we showcase an example. So here's a perfect example of this, right? We have a swing high, swing low, the market pushes to new highs. Then we have this aggressive displacement leg lower. Now there's multiple different setups in here. You could even consider this like a CISD, these up close candles. Then we have a down move here. This could have been like that first retest entry in here before this fair value gap was created, but again, that's going to be for a different discussion. Now we have the breaker, because these are the last swing high, swing low, push up, the market breaks back below, we have a structural break. Now this is going to be our breaker range in here, and we also have a fair value gap. You can typically just enter inside of the breaker range at the fair value gap if you want, like on this candle, and look how we have an aggressive displacement move lower. This is a perfect example. Now, where does the stop loss go? If you have the breaker range, like in this example here, what you can typically do is you can put your stop loss above the breaker candle's high, so like somewhere around here, or if you want to put it above the fair value gap, like let's say you want to put it above right here, or above like candle 1, 2, and 3 of the fair value gap, you can put it above that swing point as well. If you want to put it all the way above here, you can. It's all dependent on how you do, but whatever methodology you use for your stop placement, keep it consistent. Do not deviate from time to time. If you want to put your stop loss pretty aggressive, like let's say above the fair value gap overall, maybe a few pips away, you can do that, or a few ticks away, that's fine. If you want to put it above the breaker range high, you can do that as well, but stay consistent with it and then see over time, is this the proper stop placement for you? Inversely, this one's a little bit more complex, but look how we have a swing high, the market makes a new low right in here, and then we have a push up back above that swing point. So now this area now becomes our breaker range. We also have this fair value gap that's present in here. Notice how the market comes into this area. We retest it multiple times before we have them pushed up. Now again, using that same example, your stop loss could either be below the fair value gap candle. So we have candle 1, candle 2, and candle 3. Some people put it below candle 1. Some people will put it below candle 2. It's really up to you on the fair value gap creation. Now, if you want to use the breaker range, which is like this last swing high point down to the new lows, you can kind of use that one as your overall range. Put it below. If you want to use a very wide stop, you can put it below the swing point of the overall structure that broke the impulse high. Multiple ways to do it. I personally like to use the breaker range. So let's just say this big up close candle before the move lower, push up. I typically mark out that range. I'll typically put a stop loss a few ticks or pips away from that area in order for me to just give myself a little bit of breathing room and maximize my risk to reward. Now let's talk about inversions. Very similar to the BPR, but again, for this one, we just have a bullish fair value gap. The market essentially breaks that back below. We can either look for the retest, or if we have a closure, we can just enter. It's really dependent on your style. Inversely, same thing. We have a bearish fair value gap. The market pushes up, we invert it, and then we have essentially an entry point right here on a retest or on the closure above it. Again, depends on how you want to approach it. So let's go ahead, let's take a look at an example of this. Now here we have a bearish fair value gap. We see the market take out new lows, and then we have a push up. Now this is what I mean. Sometimes on the close above this, especially with the proper context, you can just enter, put a stop loss below the candle that broke above if you want. That's how I personally do it for inversions. And then you look for the market to take up some upside liquidity. If you wait for the retest, sometimes this is what happens. You don't get the retest. So sometimes imagine you have the candle closure. Maybe the next candle it wicks a little bit lower. You can take an entry. It depends on your style again. Same thing in here. We have a bearish, we have a bullish inversion. Now, this one ended up creating a balanced price range. But on this candle closure, when the market inverts this, what you can typically do is just enter right there on this candle, right? Because you don't know if this candle is going to create a fair value gap. You don't know if we're going to get a retest. So sometimes you can just enter once we invert it. Again, stop loss is above the candle in this example right here that inverts the fair value gap. This is very important. Now, some people put it right above here. I don't like that because if the next candle pushed up, maybe wicked a little bit higher to this order block, you would have got wicked out the trade and then it goes in your favor. So that's why I personally like to use it above the candle that broke below that fair value gap in this example. And then in this one over here, it would be below this specific candle. So you'd enter, stop loss, and then target whatever objective you have. Now here we have a very basic one, which is an OTE retracement. But again, if we have the market push up, maybe into a key level, sweeping liquidity, and then we have an impulse leg lower, ideally there's some sort of fair value gap. Then we typically look for the market from swing high to swing low to trade back above the 50% of this range. And then we have a move lower to make new lows, etc. Now, inversely, it's the same thing. We have the market that pushes up, an impulse that breaks some sort of structural high. The market comes back into this range from swing low to swing high, back into like 50% or below. And then we look for the market to make new highs into maybe some sort of an objective. Now here is a perfect example of this, right? Notice how the market has an impulse push up, especially during the New York Open, as highlighted by here. Then we have a breakdown below. So now we broke market structure break over here. This was the swing low. So we have swing high, swing low. I draw my fib from swing high down to swing low. We look for above the 50%. The market actually comes back into this order block, and then we have the sell-off, and here are extension targets that sometimes I use. If you want a whole video on OTE entries, let me know in the comment section below. Now again, here's another one where the market has a swing low, impulse push up, right? So we draw the fib from swing low to swing high, and then the market comes down below the 50%, and below the 50% in this example and above the 50% in this example, we can start to look for reference points. So if we have an order block here, that could be our potential target. If we have an inversion here, maybe we look to enter as soon as the market hits the 50% mark. Same thing here, we have a fair value gap that is present. Also, what do we have? We have a nice breaker point, right? Swing low, swing high, new low, market breaks back above. Again, confluence. We have the breaker slash unicorn available inside of OTE. OTE, again, is just the fib from swing low to swing high in this example, coming back below the 50%, down into 62, and then we could look to target the extensions as an objective. We could target new highs as an objective. Again, with the targets, there's so much ways to manage that. And again, guys, see how, again, all these different confluences, they kind of pair together. So sometimes you'll see multiple lower time frame entries within the same setup. Now, for the 6 confirmation entry, this is one of my favorite setup that I like to see on the lower time frame. Now, what exactly is this confirmation? It's this, the engulfing bar play. Now, again, if you guys are new to the channel, I'm going to go ahead and define these terms, but if you've been a prior viewer, you already know this is one of my favorite setups. So let's go ahead and let's define it. What is a bullish engulfing? For me, it's a candle that price sweeps the prior candle bar's low, and then we have a close above the prior candle's opening price. That's the definition for a bullish engulfing, and inversely for a bearish engulfing, it's the same thing, but in reverse. Price sweeps the prior candle bar's high, and then we close below the prior candle's opening price. Now notice it does not have to close below the low in order for me to consider it a engulfing bar candle. Now let's go ahead and let's look at it on the bullish side and on the bearish side. This alone is one of my top performing setups. Now, even I use this just for daily bias. If you guys are new to the channel, make sure to check it out. I'm going to link it in the description below. I have a whole series in regards to engulfing bars. But nonetheless, notice how right here we have a bullish fair value gap. We also have a little bit of an inversion in here. This is something called a volume imbalance. The market has trades above. Now notice, look how the market comes in, taps into this level, and then what do we form? Price sweeps the prior bar's low. We have a closure above the opening price. This gives us our confirmation to look for continued price higher. Now, a lot of people ask me, how do you go ahead and enter? On the next candle, you essentially want to see the next candle open, have a little bit of a move lower. Look how we came back into essentially this order block that was also created. And then you can put your stop loss either below the swing low, or go on the lower time frame further to see if there's any way to minimize the stop loss. That will be talked about in a different video, but nonetheless, you do not want to see the bars low being violated, and then you look for the continued push up. Now let's go ahead and let's look at this on the bearish side. Notice how this right here, the market takes out the prior bar's high, also takes out multiple liquidity pools as well, and we have a closure below the opening price. Again, guys, this is why it's so paramount for me to get this, right? Because so many people, the way that the traditional retail method, they don't have this requirement to take out the prior bar's high in this example, but they also need to see a closure below the low. For me personally, I just need to see it below the opening price. Now again, same thing happens. Next candle opens, price rallies back up inside of the bar's range, and then we could look for potential sell opportunities. Again, stop loss goes above the high, and then we look for the market to trade lower in this example. Again, when we couple this with our overall bias, this can really put ourselves in a position to catch phenomenal trades with great risk rewards, especially when we add all the things that we've talked about, like time component, runs on stops, daily profiles, weekly profiles, and then this can just create a full model in itself. Now again, guys, remember, I just want to clarify this. We need to have context to use the lower time frame entries. The lower time frame entries are just that, they're just patterns. But again, when we couple it with the proper context that we stated earlier, now we have a framework. Now, make sure that you guys are subscribed, because in this next video, I'm going to be talking about how we can use lower time frame entries as well as higher time frame narratives, and how we can collectively use it together. And I'll show you guys multiple examples of combining a higher time frame bias with a lower time frame entries, and the next video will be multiple examples of just this. So make sure to subscribe, make sure to join the public Telegram, link is in the description below, to keep up to date with all my trading resources.